And like for instance, you based on what you told us but not what you're doing, you are more inclined to do conservative investing, which would be the return rate would be 5.25% before tax and 3.7% after tax. But see, the thing is that the inflation rate, is about 3% now. So if you invest in like that, you are not letting your money grow, and you end up not having enough money, when you like to retire, or when Becky is ready to go to college. And so one of our main objectives as far as your investment is concerned is to diversify. And diversification can help even out price swings during the normal ups and downs of the stock market. But it cannot, insure against loss. But if you have long enough time, you'll be okay, because it'll fix itself as long as you're watching where your money is. You may need to hire a financial manager, where actually an investment manager, where he can help you with where and how you should invest. But that doesn't mean that you take a break and let him do whatever. You have to have open lines of communication with this person. You have to be aware of what your portfolio is doing, and if it's doing what you're expected to do, and it's gonna get you where you need to be, which you like to retire at age 62. And Lucy did talk about dollar cost averaging, and how by investing regularly, dollar cost averaging will help you to achieve your goal faster and more systematically. Another thing I'd like to suggest, especially when it comes to Becky's college fund, is you may want to consider growth and income stocks, or mutual funds for Becky's college fund. And we did a calculation for the amount of money you're gonna need for Becky's college fund. You told us that you think she's gonna go to a good public university, and the cost of her education would be $10,000 per semester for 4 years in today's dollars, which would actually be in today's dollars would be $18,857. If you invest aggressively, moderately aggressive, at a rate of 10%, you would need to save $134,599 to have enough money to cover Becky's education, which would mean you would need to save about a little over $5,400. If you save moderately conservative at the rate of 7.75, you would need to save $141,169, which would translate to $6,676 per year to have enough money to cover Becky's education. Now, where should you invest for Becky's education? You should consider a 529 plan to invest for Becky's education. The benefits of a 529 plans are, first of all, you have federal tax benefits because the interest that you earn on the money invested, you don't pay taxes on it. It also has state tax benefits, and you have control of the funds. So it is not like an Otma that you would, after she reaches legal age, you don't have any more control on the money. You have control on the money if you put the money in a 529 plan. And the tax reporting is simplified. It is very flexible, and you can make substantial deposits to this account. Actually, what you could do is you could, between you and Tyler, you can deposit $28,000 to this account every year, and you won't have to worry about any gift taxes, because you get a $14,000 deduction per person. So for the two of you would be $28,000. Now, we have done some research for you on different 529 plans. Missouri does have a 529 plan, and federal and Missouri tax deferred growth and tax-free qualified withdrawals you get with that, and you get state income tax of $8,000, and if you're married, for you it would be $16,000. And there are also other plans for from other states that we did research on, and we have included in your plan. I didn't go into details about what Missouri 529 plan has to offer you. You can read it, and by all means, if you have any questions, feel free to call me or Lisi, and we'll go over it with you in detail. I just don't want to give you too much information all at once, and then you go home and you say, oh, what happened? And there are some plans that are recommended and highly rated by Morningstar. One of the plans is what Utah has to offer, so you may want to look at that. We focus mostly on the Missouri plan, but by all means, please choose the one that you see most fit your plans and what you like to do. Okay, and I think Lucy also talked about U.S. Government savings bonds that you have, and at some point Taylor's parents gave you as gifts. Right now you have $25,000 in miscellaneous savings bonds, and the bonds were purchased 12 years ago, and they were gifts to you and Tyler, and the bonds will earn interest for the next 15 years, and and reach their 30,000 face value in another 5 years. And your EE bonds are not subject to a state income tax. You can either save those EE bonds as a backup for Becky's education. I'm not saying go cash it, because if you do cash it, then there'll be some tax consequences. So please, if you're planning to use it for Becky's education, just hang on to it until the time comes. Also, when you think about it, it could be a little cushion as your backup for your emergency fund. If you have it there, and if you need to cash it, then cash it. Otherwise, let it sit there, and it's not earning much interest, but it's good to know that you have it. Let's talk a little bit about your IRS. Both you and Tyler have traditional IRAs. The money is sitting in CDs. and they are earning about, I think, 3% interest. And if you once they mature, they may want to invest the money in something else, so you have a better rate of growth. Mia also has rollover IRA, which is currently invested in Ruth Fund, and we'll also go over how you are gonna diversify your investments and what changes you need to make to your investment funds so you have a better earning rate on your investment funds. You also have two checking accounts. Your current checking account is a non-bearing checking account, so we suggested that maybe you want to check and see if you belong to a credit union, or some banks offer no annual fee checking accounts. They also pay you interest on the money in your checking account. So you may want to check into that and see if you can switch banks or switch type of accounts. There is money sitting in another checking account, which is non-bearing interest checking account, and also I think you said you earmarked that money for the art gallery that Mia is thinking about opening once she retires. And we like to suggest to you that maybe use that money to pay off your credit card balances and get that out of the way, because you're paying so much interest on those two credit cards. We are also suggesting that maybe before building your emergency fund, well, I already talked about building your emergency paying off your credit card, so just scratch that part. I'm getting ahead of myself. Also, we are thinking maybe the money for your emergency fund, or the money that you have set aside in your cash reserve, you may want to invest that in Missouri municipal bonds. It is not FDIC insured, but it seems to be pretty safe. Before I do any kind of investments like that, I would definitely talk to a financial advisor and make sure that you understand the consequences of doing something like that. You own mutual funds. We had our friend Randall Lee do some analyzing of your funds, your investment funds, and the mutual funds that you have in your portfolio. And he utilized risk-adjusted performance measurements like Sharpe ratio, Trainer ratio, and I have a little paragraph about what a Sharpe ratio is and how it works, and the higher it is and the lower the standard deviation of your portfolio is, the better off you are. That is also in your plan, and please look at it, read it, and make sure that you understand what I'm talking about. And then once you understand where I'm coming from, then this would make sense to you why we say that you need to get out of some of the funds that you're in, and then diversify your investments in some of the other funds that you're already in, but it's just you don't have that much investment in.